Hey, this is Erik, and welcome to Two Sats.
Disclaimer: I am not a financial advisor.
Today, we're going to debunk some Bitcoin myth. Ever since Bitcoin reached its near $20,000 high in December 2017, everyone and their grandma have heard about the magical internet money. Bitcoin's inception was in January 2010, and it has been called many things, from a scam, Ponzi.
We got some bitfucks in there, I can tell. Too bad. Shows you the stupidity. Bitcoin is going to zero. Zero. When it comes out, zero.
To digital gold, a store of value, and the single biggest investment opportunity in our lifetime. Today, Bitcoin is recognized as an emerging global asset, and many reputable investors, asset managers have embraced Bitcoin as an asset class with an asymmetrical return that it's either worth zero or millions of dollars each coin.
And I've always thought of Bitcoin as a very binary investment, whether it goes from 80 to 8,000 to 6,000 to 3,000 to 13,000, it doesn't matter. This is either zero or it's millions.
However, many Bitcoin myths are still around, and recently a leaked Bitcoin slide from Goldman Sachs said, "We believe that a security, Bitcoin, whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it, is not a suitable investment for our clients." They have pointed out 5 reasons supporting this claim. Bitcoin do not generate cash flow like bonds. Bitcoin do not generate any earnings through exposure to global economic growth. Bitcoin do not provide consistent diversification benefit given their unstable correlations. Bitcoin do not dampen volatility given historical volatility of 76%. On March 12, 2020, the price of Bitcoin fell 37% in one day. Bitcoin do not show evidence of hedging inflation. This has gained a lot of attention. And in my opinion, the slide is a lot of shit. Excuse my French. Ark Invest, an asset management company focused only on innovations, has released a blog to debunk a few Bitcoin myths, even openly invited Goldman to have a debate. Before I get to Ark's blog, let me respond to some of those points in the slide by Goldman. Bitcoin do not generate cash flow like bonds. That's a fact. Not a criticism. It's like saying the sky is blue. Not all assets generate cash flow, for example, gold, and many stocks that have appreciated massively in value, such as Netflix, Tesla, have never paid a dividend. Bitcoin do not generate any earnings through exposure to global economic growth. Bitcoin do not provide consistent diversification benefits given their unstable correlations. This is the whole point of having an uncorrelated asset in a portfolio. Because Bitcoin is not tied directly to global economic growth, this is the ultimate diversification. Anyway, let's get into Ark's blog. Claim: Bitcoin is too volatile to serve as a store of value. Ark's counterclaim: Bitcoin's volatility highlights the credibility of its monetary policy. This is due to an impossible trinity problem in macroeconomic policies. The triangle shows 3 design features of any currency. They are fixed exchange rate, free capital movement, and independent monetary policy. Currency can only optimize for 2 out of 3 features, as the third will contradict one of the first 2. For example, the gold standard ensures the currency a fixed exchange rate to a specific weight in gold. This also allows for free capital movement because the authority cannot control the supply of its currency, aka gold, since the amount of gold is dependent on mining. Therefore, in terms of Bitcoin, it limits the growth of the money supply and allows for free flow of capital, which is the main feature, censorship-resistant. This means Bitcoin's design cannot include a fixed exchange rate. Also, Bitcoin's volatility is decreasing over time as its adoption increases. I just want to add to Ark's response. The market capitalization of Bitcoin is still small. At the making of this video, although it seems expensive, with each Bitcoin worth $11,700. Because of its limited supply, the total market cap of Bitcoin is under 220 billion, which is very small relatively, considering the size of the US dollar is 3.3 trillion and the value of gold is around $10 trillion. The stocks listed in the New York Stock Exchange and the Nasdaq have a total market cap of close to 40 trillion. Even crazier, check out this visualization of money and markets in the world. I have it linked in the description. Each black square represents $100 billion. Because of the small market size of Bitcoin, far less money will move Bitcoin price significantly, hence the volatility. But Bitcoin shouldn't be excluded as a store of value because of its volatility alone. Ark has stated that over long time horizons, Bitcoin's purchasing power has increased significantly. Since 2011, for example, the price of Bitcoin has compounded at an annual rate of roughly 200%. And despite significant intra-year moves, it has appreciated on a year-over-year basis every year since 2014, as measured by its lowest value of the year. The value of a store of value is the protection against the loss of purchasing power in the long term. In the short term, the major currencies of today, the dollar, the pound, the Chinese yuan, the Japanese yen, are all good options to protect against short-term volatility. But in the long run, 10, 20, 30 years, the 2% annual inflation target will eat your wealth away. Claim Bitcoin will lose value to forks and digital copies. Ark's counterclaim: Bitcoin's value cannot be replicated by software alone. Bitcoin is thought as digital gold, with its predefined 21 million coin limit. But because Bitcoin is digital and intangible, and the Bitcoin software is free and open source, anyone can copy the software and fork the network, creating their own version, which in turn diluting Bitcoin's value. This is totally wrong, because copying the Bitcoin network does not create new Bitcoins. This is the equivalent of thinking counterfeited British pounds or the US dollars will dilute the existing money supply. Of course, that's not true because they are fake. It's the same logic for Bitcoin. Another reason is the Bitcoin network is supported by its miners, which provides a huge amount of computation power to the network, protecting the network against attacks and process Bitcoin transactions. A Bitcoin copy does not have this computation power to protect itself against attacks. The security is a pivotal part of Bitcoin. A new Bitcoin network without the miner support has no value. Also, the network effect of Bitcoin does not only include the computation power to secure the network, but also Bitcoin's liquidity and the infrastructure supporting its adoption and usage. For example, the ASIC miners used for Bitcoin mining are now a maturing industry, worth billions of dollars in value. The fiat on-ramp for Bitcoin is widening day by day, meaning easier user onboarding for Bitcoin. Lastly, Bitcoin Cash is the most well-known Bitcoin fork so far. This is the price chart of Bitcoin Cash denominated in Bitcoin since the fork in 2017. Clearly, the market knows which one is Bitcoin. Claim: Bitcoin wastes too much energy. Ark's counterclaim: Bitcoin's energy consumption is more efficient than that of gold and traditional banks. The Bitcoin network uses far less energy, and it is the most secure and censorship-resistant network in the world. From that perspective, Bitcoin is very energy efficient. Additionally, Bitcoin miners only require electricity and internet connection, which means Bitcoin's infrastructure is highly flexible. Efficient mining operations that are using cheap, renewable energy will ultimately make miners who are using more expensive, dirty energy out of business, resulting in Bitcoin's energy consumption to be potentially way more environmentally friendly and will become more and more green in the long run, as renewables like solar, wind, hydroelectric are a much cheaper source of energy. Well, all this sounds great, but Bitcoin is for criminals, right? This is what many people think of Bitcoin owners. In reality, these are the Bitcoin holders. Chamath Palihapitiya, billionaire venture capitalist, early senior executive at Facebook, founder and CEO of Social Capital, chairman of Virgin Galactic. Catherine Wood, founder and CEO of Ark Invest. Her innovation-focused ETFs are among the top-performing ETFs in the world. Naval Ravikant, Silicon Valley's most well-known billionaire angel investor, founder, ex-CEO of AngelList. Jason Calacanis, billionaire angel investor, famously for investing in Uber. Jack Dorsey, founder and CEO of Twitter and Square. Anthony Papliano, co-founder of Morgan Creek Digital. Patrick O'Shaughnessy, CEO of O'Shaughnessy Asset Management. And the last but not the least, a stranger that I met in a pub. He is an immigrant construction worker looking for a better life for his family. He's holding Bitcoin as investment because he understood the value of decentralized, censorship-resistant form of money. And he also regularly using Bitcoin as a remittance tool to send money to his family overseas. Whether Bitcoin is an investment opportunity of a lifetime or not, that's up to the individual investor. However, dismissing it with lazy arguments and false information, it's certainly pretty dumb. Don't be a sheep, think for yourselves. And as usual, thanks for listening. I'll see you in the next one.